They say money doesn't grow on trees, but have you seen the price of lumber lately? Jokes aside, real estate has always been a tempting investment. It's tangible, it's usually appreciating, and it feels like a proper grown-up thing to own a piece of the planet. But before you dive headfirst into the world of property, let's pump the brakes for a second. There are different ways to get your hands dirty or not in the real estate game. First up, we've got the classic rental properties. This is exactly what it sounds like. You buy a house, an apartment, maybe even a parking space if that's your jam, and you rent it out to tenants. They pay you rent every month, you cover the costs, and hopefully you pocket a tidy profit. Think of it like owning a hotel, but you only clean the rooms when the guests trash the place and leave. Being a landlord can be rewarding both financially and in terms of personal satisfaction. You're providing someone with a home, and that's a good feeling. Plus, you get to play Bob the Builder every now and then, fixing leaky faucets and unclogging toilets. Just kidding, you can hire someone for that. Now, if the thought of dealing with tenants and toilets makes you break out in a cold sweat, don't worry. There's a less hands-on approach, REITs, or real estate investment trusts. These are like the chilled-out cousins of rental properties. Imagine a big company that owns and manages a whole bunch of properties, shopping malls, office buildings, even those self-storage places where people hoard their old Beanie Babies. That's basically what a REIT is. You buy shares in the REIT and they handle all the messy stuff. You just sit back, collect your dividends and pretend you understand what a net asset value is. REITs are a lot more liquid than physical properties, meaning you can buy and sell them easily on the stock market. It's like trading Pokemon cards, but instead of Charizards, you're dealing with office parks and hospitals. Section 4, weighing the pros and cons, landlord headaches versus passive income. So, which one is right for you, being a hands-on landlord or a laid-back REIT investor? Well, it depends. Rental properties offer more control. You choose your property, you choose your tenants, hopefully, and you can even paint the walls whatever wacky colour your heart desires. Plus, there's the potential for higher returns, especially if you're handy with a toolbox and can avoid calling expensive plumbers every 5 minutes. REITs, on the other hand, are all about passive income and diversification. You don't need to fix leaky faucets, chase down rent checks, or know the difference between a mortgage and a mortgage broker. You invest in a REIT and they handle the rest. Plus, REITs offer instant diversification. You're not putting all your eggs in one basket, or in this case, one slightly drafty apartment. Section 5. Show me the money costs, commitment and control. Let's talk numbers, shall we? Rental properties require a significant upfront investment. We're talking down payment, closing costs, and probably enough cash left over to bribe your real estate agent with a decent bottle of scotch. You'll also need to factor in ongoing expenses like property taxes, insurance, and the occasional emergency repair when the boiler decides to throw a tantrum in the middle of winter. REITs, on the other hand, are much more accessible. You can start investing with a relatively small amount of money, and there are no closing costs or property taxes to worry about. However, you do pay management fees to the REIT company, which can eat into your returns. Section 6, the finish line. Which one's for you? So there you have it. Rental properties versus REITs. It's a bit like choosing between a manual and an automatic transmission. Both will get you from point A to point B, but the experience will be quite different. If you're a hands-on type who enjoys a bit of DIY and doesn't mind the occasional late-night call from a tenant whose cat is stuck in the washing machine, then rental properties might be your speed. But if you prefer a more passive approach and value diversification and liquidity, REITs could be the way to go. Ultimately, the best choice depends on your individual circumstances, risk tolerance, and how much you value your free time.